Hey traders, this is Ron Haydat, Market Tamer. Happy Sunday. Hope you guys are having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk, and specific financial issues should always be addressed with your financial advisor. We'll lead off here with the SPY, the S&P 500 ETF. Now, the spiders itself did close at new all-time highs. Take a look at the SPX. You can see we're not. We closed at 2907. And if we go back to September 20th, we closed at 2930. So we're about 25 points off the all-time high on the SPX itself. Now, if I go to the diamonds ETF, here it closed at 265.14. We closed at 264.07. That's a buck. Basically, it's 100 points, essentially, from the all-time high on the DIA. But across the board, the bulls have the edge. The naysayers, once again, that's why I used tuning the noise out as Thursday's subject line. Here we're bearish, and we get the reversal. We're just not, and the bulls just get the edge. And all this news back here that was all of a sudden bearish, we all knew about over here, and we still know about here. This was just, in my opinion, an orchestrated flush. And now we're sitting right back up the all-time highs. Whether or not we continue to go higher, we'll just wait and see. I like the motto, trade what you see, not what you think. Yes, I'm bullish. However, we start breaking moving averages, it's easily become bearish as well. We take a look at the Qs. They finished higher on Friday too. Right now, they're riding their 5-day EMA in blue, which is the short-term moving average. It's been pretty strong, but it's been a slow pace. You take a look at the IWM, the Russell 2000 ETF. And you can see how badly this one's lagging the overall market. While the Dow, the Qs, and the SPY are all back at their all-time highs or challenging it, the Russell is way, way off. It hasn't even closed above these highs yet, back from the end of February. And then if we take a look at the mid-caps via MDY, they're doing better. I mean, the IWM is doing the worst right now, but the MDY, second worst. It's getting closer to getting back up towards 370. So again, bullish across the board. Taking a look at VIX, it actually dropped 12.01. The old range, June, July, August, September of a year ago, I mean, that was 4 months, was down in the 12, you could even say 11, 12 to 13 range, something like that. Well, now we're at those levels. It's my, how things can quickly change, right? Right back to a lot of complacency, which brings up a commonly asked question. Well, if the VIX is this low, does that mean the reversal is imminent? A reversal at some point will happen. We will get a market pullback and VIX rise, but if I use VIX and I take you back 5 years, remember, each block now is an entire year. Look how long we can stay below 14, 15. It can go on for quite some time. So just because we've gotten there now, yeah, there might be reversal, but like over here, it could take a third of a year before that happens. So who knows? But bulls have the edge, period. And then let me just go back and look at the SPY here. On a weekly basis, you can see how strong it is. We put the low in, Christmas Eve massacre. Then we started getting back above, and now we're actually just pushing up. You take a look at the Qs. A similar story on the weeklies. So dailies, weeklies, everything is siding with the bulls. All right, let's take a look at earnings. So JP Morgan had earnings this past Friday, and we gapped up and took out these previous highs. That's good for the whole stock market. Not that I like JP Morgan, Chase, but it's good because, hey, this bank is moving higher. The previous highs up in the 115 range would be the target. This coming week, we really get into a full week of earnings, well, sort of a partial week of earnings, because the markets are closed on Friday. So we have 4 days, but earnings is going to pick up massively. Stocks like Citigroup will have earnings tomorrow, Monday, before the market open. If you look here, it's 4:15, 8:30 a.m. It gapped up already with JP Morgan. If the earnings are, I wouldn't even say if they're good, it's how does the big money react to those earnings? But the target right now technically would be up there, right around $75 a share. Now, Netflix is a stock that does move on earnings. This one is coming up to a report on Tuesday after the market. They're actually showing noon, but I'm pretty sure it's after market according to the CBOE, if I recall. But nonetheless, Disney came out. They're announcing Disney Plus. This sent Netflix down. They're calling it the Netflix killer. I personally, I don't get into all that stuff. They like to make headlines and get clicks and all that good stuff, but we have to wait and see. The bottom line, though, is with Friday's pullback, earnings coming Tuesday, not a bad time to consider a protective put example on something like Netflix. And if I bring in Netflix, and if I was going to, again, from an educational perspective, use a protective put for earnings, usually 90, 120, I can go as low as 60. Anything in there can work, but September is 159 days, so June just might be enough. It's sort of the bare minimum. The stock's at $351. So an at the money put is going to cost $2,170 a contract right now. $2,000, a little over $2,000. That's a lot. But so is holding 100 shares of Netflix at $35,000. So a good one in practice would be to consider doing this. Again, paper trading portfolio. Just write it down on a piece of paper. We can revisit after the company has reports, check what the option values are. If the stock goes up, the put's going to lose value. If the stock goes nowhere, the put's going to lose value. However, if the stock drops a lot, enough, then this put can save the trader's bacon, really protect the portfolio. If it only goes down a little bit, the implied volatility drop, suck out, if you will, that's what they refer to it as. The stock drops 5, 6, 7, $8, the puts just aren't going to gain anything. Until volatility gets sucked out, nothing will happen. But this is why it's so important, in my opinion, to practice these puts. And I sort of do this as a broken record 4 times a year with these earnings reports that come out. But a good one where it would have paid off was Duluth. I think their commercials are hilarious. But the stock's not doing that well unless you're a bear. The stock gapped down on earnings, but look what happened. It went from right around 23.66. Now it's at 16. $6. That's huge it's about a 30% drop. But having a put for earnings, again, would be saving massive capital. And you can see how the lower highs just keep getting set. We have lower lows. If I go back and show all the data on Duluth, you can see we go back to 2015 with this kind of big bar. There's going to be some support where it comes in right now. But if that support gets fractured, the next stop, technically, 13-ish, something like that. All right, ANTM, which is Anthem. This thing, it broke out here, right? Then we come down, we come up, and then we come back down. And once we get into the gap, it comes down lower, and then it tries to rally. And I'm showing you this because it looks like a powerful move here, but then it just stops for whatever reason. We break moving averages, but then we hold the 50-day in orange, which is an institutional moving average, but then we bounce, but then we put in a lower high. Now, this is concerning if you're a bull because you have a lower high, the lows are holding. So what's really going on here is either a reversal or we're getting a box. But then we break the previous low, we come into the gap, we rally right into the red line. That's often used as a trailing stop, the way I like to teach it. That's a 20-day exponential moving average. That's a bad sign. It's like, oh dear, we're into the gap, reverse, but we run into a moving average and we roll right back over. It cut through the 200-day moving average like a hot knife through butter in the middle of summer. Blew through that. Now we're already down at this level. That's how quickly. So if I was trading a stock like this, and the gap should be support, and we break the gap, bad news. We then rally, can't get above moving average, bad news. And now the bottom just falls out. So just some technical analysis help there. Spot when your stock could be in trouble. The signs were there already the end of March. And when you see a failed breakout, that's more bad news. Because look at it this way too. What was once, I see a gap up is now going to be support. The test here was support. Now it becomes resistance. That's TNA 101. Here is United Health. This thing just blew through 235. It was clinging to it on Thursday, completely lost it on Friday. They have earnings coming up on 4/16, which is going to be Tuesday as well. But once we started even rolling over on Thursday, that was a bad sign ahead of earnings. And I'll tell you what, in practice, what I found to be really good, and you can practice it in a paper trading portfolio, is about a week before earnings, not a bad idea to consider looking at puts already. And that way, if there's a little bit of a sell-off ahead of the report, you're covered. But the next target for UNH is back down around 210. Let me delete that line. So the low from February of 18 and March of 18, it's still $13 lower. And now UNH is setting lower highs. That's not looking good at all. So that's it, gang. I wish you guys a fantastic holiday week. Remember, U.S. markets are closed on Friday, so I'll have a 3-day weekend. Take good care, and I'll catch you in the next video.